have made a sought-after commentator, and his expertise has been featured extensively in news outlets, including CNBC, where he's a frequent guest. So we are super honored to be able to welcome him today. So let's give a big round of applause for Logan Mohtashami, please.
Thank you. Can you all hear me? Okay, good. How's everyone doing today? Good. This is my 19th event of the year, second time in Utah. And last year my theme was the worst in housing was over. But this year, for the first time in many, many years, what I'm going to present to you is how to look at the housing market, not only for this year, but going out for the next few years. So what is really going on in the housing market? My first chart used to be about mortgage rates and the 10-year yield, but now this is the existing home sales data going back to the late 1960s. What typically occurs in the history of housing economics, rates go up, sales fall. We've had 3 dramatic sales periods since the late 60s, and then a base is built. And that base that we've seen in our data in America in 2022, 2023, 2024, and 2025, what occurs is inventory goes up, price growth slows, housing gets affordable that way. Then mortgage rates start to go lower. So this housing cycle reminds me a lot of the early 1980s. How many people here know that home prices rose faster in the late 70s with mortgage rates going from 8 to 13% than during the COVID period with sub 4% rates? How many people know that? Not a lot of people do. Housing was less affordable in the 1980s because mortgage rates went up 18%, home prices grew faster, so we had a crash in home sales. But even with that, a lot of people said, nobody's going to buy homes again, everyone's going to be a renter. The first recession came, rates went lower, home sales went vertical. Then the second recession, where people say, okay, that's it, nobody's going to be buying homes, affordability got better the same way affordability is getting better right now. And then rates went lower, vertical home sales. And then it grew for years. And in fact, if you look at the gray bars here, those are recessionary periods. Those are when housing sales bottom and then grow for years. So what I'm telling you today is for the first time in many years, inventory's up, price growth slows down, wages are rising faster than home prices, affordability is better that way, but then mortgage rates go lower. So when we talk about housing economics, the next chart is inventory. This is the total active inventory for the NAR going back decades. Normal, 2 to 2.5 million. 2007, 4 million. Today, 1.22 million. So when people tell you, oh, it's housing 2008, home prices are going to crash, the history of home prices going back to 1942. If I take 2007 out of the equation, 2007 to 2011, that period, how many years did home prices fall? 1% post-World War II. Anybody want to guess? 0. How many recessions have we had? How many crisis events have we had? The only time home prices fell outside of 2011 to 2007 to 11, 1990 home prices were down 0.7%. 1991, they were down 0.2%. So you'll have access to this chart. If you're running to clients that think, oh, 2008, I'm just going to wait for home prices to crash. Look what happened here. In 2005, inventory is 2.5 million. It went vertical to 4 million. Why? The housing market, the credit markets were breaking. How I explain the last 13 years is always keep this in mind with housing. 70 to 80% of home sellers are buyers. That 20 to 30% of inventory is left. Who buys a house that doesn't give you, or who buys a house that doesn't give you a house originally? It's a first-time home buyer. It isn't BlackRock. It isn't Blackstone. It was the millennials. And who was the biggest demographic patch in the history of America? Millennials started to buy in 2013 And those pesky kids did not give you a house. So inventory started going lower and lower and lower. Then we hit a really bad spot. Years 2020 to 2024 has the biggest housing demographic patch in the history of America, and inventory broke to all-time lows. So home prices escalated out of control, very similar to the late 1970s. The late 1970s, labor force growth was booming. You know, the millennials now were the baby boomers back then. Home sales took off, prices took off, then rates went up, affordability got the worst in history, sales crashed, they found a bottom, and then sales rise. So what's happened here is this is positive, not a negative. Inventory being low, prices outpacing wages, bad for everyone in this room. But for the first time ever in the post-COVID era, affordability is at a 4-year high because price growth slowed down. Right? In the 1980s, inventory was much higher back then. Prices didn't decline back then either, but they slowed down. So now we're in a better spot by itself. And because of that, purchase application data last year was the first positive year in many, many years. But we're also working from the 1990 levels. It was a very, very low bar. Now, when I like to remember about the 1990s, how many people here remember the 1990s? Right? I always say the growth that we saw last year needs to be in context because No Doubt was a new band. Gangster Paradise was the #1 song. I had blonde hair. I was auditioning for Levi's commercial. So the growth that we had last year needs to be put in context. But before the snowstorm came, weekly pending sales, purchase application data, total pending sales, how we track it, was all positive. And that makes sense to us with the history of housing economics. Right? Purchase application had the best start of the year. It's still, even with the snowstorm, has been positive year over year every single week. And the best thing is that mortgage volatility has gotten much better. Now, how we track housing data is our weekly pending sales. This is a little bit different than other people. These are the homes that go into contract, and in about 30 to 60 days, they go into the existing home sales market. Things started to get better mid-June 2025, when mortgage rates broke under 6.64 and then headed down towards 6%. We had about 420,000 more existing home sales from the bottom of June all the way to December. December was 4.35 million. That was actually higher than my forecast for 2026. So the housing data always gets better when rates are near 6%. Then we had the snowstorm. Then we had the holidays. Always remember this going out in the future. The last 2 weeks of every single year, housing activity tanks. Especially if Christmas and New Year's are in the middle of the week, nothing happens. So many, many months before that happened, I said, I'm not even going to write my weekly reports because it's going to tank, and then you're going to see a bad existing home sales report, and everyone's going to make a big fuss about it. It was just the holidays. And then snow came. Once that leaves the data line, we were very positive to start the year. So this is with rates still above 6%. So affordability got better, inventory's up, price growth has slowed down. Now, pending sales are going to come in, and when March and April come, the sales data will pick up. This looks a lot to me like previous cycles after sales have bottomed. But we needed the inventory growth. So all positives going into 2026. Now, I used to always start off all my presentations and ask everybody how many people have been married here for over 20 years, how many people love the slow dance. The slow dance between the 10-year yield and 30-year mortgage has been here for decades and decades. But what drives this is 65 to 75% of where rates can go is still Fed policy. So right now we have slower home price growth, wages rising, inventory is up, but we also have 1.75% rate cuts into the system. We didn't have those in the previous years. So how many people here have noticed that the volatility in rates is much lower now than what it was in the past few years? You don't get that wild kind of crazy action. Back then in 2023, mortgage spreads were high, the Fed was still hiking rates. All that is over. And I'm not even counting that we go into a recession, but the rate variable has improved so much because the 10-year yield if you look at this, last year was really confusing for everyone. A lot of people said, Logan, rates can't go lower. Inflation is picking up. We have $38 trillion in debt. We have $10 trillion of supply of bonds. There's no way rates can go. But what happened? I have a little saying I created in 2022, labor over inflation. What's going to matter to the bond market and mortgage rates is that the labor market got softer. That was the theme of last year. What happened? 2025 was the lowest job growth in the 21st century. We averaged 15,000 jobs per month. We only created 181,000 jobs for the entire year. And the bond market did what it always does. It gets a little bit ahead of the Federal Reserve. The Fed catches up. We have a lot of rate cuts in the system. So mortgage rates are near 6%, and they have not spiked like they did in 2024. So a lot of people said, oh, the Fed's going to cut rates again, inflation is going to take off, rates will go up. That's not how the history of mortgage rates operate. When the Fed is cutting rates and mortgage spreads get better, rates go lower for longer. So it didn't surprise me, but I could understand why so many people were confused that rates went lower last year. Now, the best chart for everyone in this room, how many people here are familiar with mortgage spreads? The concept of it, okay. 3 years ago, I went to a big mortgage conference and I asked that question. There was only 3 hands up and there was like 1,000 people there. So I was like, okay, I've got to teach mortgage spreads because this is the reason why rates are near 6% and you don't have volatility. If we believe that the slow dance is between the 10-year yield and the 30-year mortgage, what do we want? We want intimate, 1970s, Soul Train slow dancing, very close. The spread is the gap between these two slow dance partners. 2023, it got 3.11%. Today, if we had the worst levels of the spreads in 2023, mortgage rates are 7.25%. Easily. They're near 6% now. The history of mortgage spreads is that when the Fed is done hiking rates and they start cutting, mortgage spreads improve. Now this is about the nerdiest data line and not a lot of people. So now we went from 3.11% to below 2%. Normal is 160 to 180. So we got a little bit more room of improvement left, but what this does is volatility compresses, right? So all of you now get to work with more inventory, affordability getting better, mortgage rates near 6%, and less volatility now. And this looks like almost all the housing economic cycles we've had post-World War II. So this doesn't usually get worse after it improves. Why do spreads get worse? When rates shoot up fast, investors need to be compensated because of early payoff risk. If there's a quick recession that comes out of nowhere, spreads could get worse as well because early payoff risk or people not making their payments. But now, this is the reason why mortgage rates are near 6% and you barely have any volatility. And this is going to stay with all of you for the entire year and going into 2027 and 2028. So the worst being over last year is already done with, but we're almost back to normal. And this was happening before the government announced the $200 billion mortgage-backed security purchases. That's a $7 to $9 trillion market. It trades like $300 billion a day. So this is a positive for all of you because now you can work with your clients with lower rates for longer.
Logan, can I interrupt you? I'm getting a lot of questions. Are you okay to share the slides? Can we share the slides with people after?
Oh, the QR code at the end gives you the slides.
Okay.
Yes.
So you'll have a QR code at the end where you can get access to all of these slides. So you don't have to take pictures of
yes.
slides.
Don't have to take pictures.
Okay.
So that's the spreads. Now, if I believe labor over inflation is the key to mortgage rates staying lower. So what's really going on with the labor market? Unemployment rate, 4.3%. Lowest job hirings in the 21st century, but not a lot of fires. That's the thing, right? When we look at the jobs data, if it really wasn't for healthcare and social services, we would be down 900,000 jobs last year. That's pretty much our job growth comes from basically 2 sectors. This was the last job breakdown. So what's occurring is we're not doing a lot of hirings, but we're not doing a lot of firings. And because of that, the unemployment rate has stayed lower. Population growth has slowed down. Immigration has slowed down. There's less people looking for work. So that keeps rates, the unemployment rate lower than what it traditionally be. This would be near 5% if we had the labor force growth that we had a few years ago. But it's good enough to keep the spreads better. It's good enough to keep the 10-year yield low. And if we look at the history of housing cycles, the worst is already overdone with rates. But now you get to operate for the first time, more stability, lower rates, better affordability, and this could be here for years to come. All of this is positive for the housing market. I couldn't say this in the last 3 years. I couldn't have all those variables come into place. Now, inventory. We track inventory a little bit different for HousingWire. We track it weekly, single-family homes available for sale without any contracts, which is different than the NAR, Redfin, and Realtor.com. Inventory was growing very good last year. At one point, we had 33% year-over-year growth. Then June came. Mid-June, all of a sudden, inventory growth started to slow down, right? Unlike 2024, what happened? It's very simple. 10-year yield went lower, mortgage rates went lower, demand picked up, supply and demand equilibrium, so much that the inventory growth is now down to 8.24%. Florida, parts of Florida are down year-over-year inventory, almost 10%. Their sales are up 10%. They're working from a very low bar. But if the inventory growth stays the same, we're going to have some negative year-over-year prints this year. So if you run into clients, you know, what we do, I talk about the national, we can break this down for any city, state, zip code in America, is that inventory is growing in a healthy clip right now, but it's not breaking out of control. Very simple. Rates went lower, spreads got better, inventory is up, affordability got better on its own. It's a very stable, almost a normal housing market year, which we haven't had in a while. Now, this is our bread and butter data line. This is the new listings. This data line shows the homes that are coming onto the market that don't have a contract, very seasonal. But what it is the last 5 years have had the lowest new listings data in history. You know, all these things we've heard about, the Airbnb crisis and Wall Street buying all that, they're going to sell everything. New listings data right now this year looks normal. We're just going to try to get back to 80 to 100,000. We haven't been able to do that for years. Most sellers are home buyers. You want the new listings data to pick up. We were starting good, then the snow came, and now that the snow stuff is relieving out, we're picking up on new listings data, so another positive here. But if you run into people that say, I don't want to buy a house, every YouTube video tells me home prices are going to crash, this data line for us was running at 250 to 400,000 per week during the housing bubble crash years. Just to give you an example, Mike Simonson, who's my colleague, who's now the economist for Compass, he took this data line, he went to Wall Street, Lehman Brothers, 2007, said, Lehman Brothers, we have a way of tracking housing. It's a little bit different than everyone else. The housing market's breaking in our, he said, we don't know who you are. We have 85 analysts, go away. Mike Simonson walked 20 feet, saw Goldman Sachs, showed Goldman Sachs the same data. Goldman Sachs took it, bought it, shorted the housing market, made $10 billion, Lehman Brothers went out of business. We believe we are the most prolific housing trackers on planet Earth. We are not shy about it. We'll debate anybody on planet Earth on this because we track data a little bit different and it looks normal to us. So I know your clients run into crazy YouTube people, crazy people on Facebook, Instagram, TikTok, and everything. Trust me, I've debated some of those people. They are not housing experts. They have no working models. This is a working model. Housing looks pretty normal this year. But affordability is better, inventory is up, price growth is cooling down, and new listings data is going to have a normal year. So you can show these to your realtors and clients and everybody on how housing economics have worked for decades and decades and decades. Now, 1/3 of all homes in America have price cuts. When inventory is up, rates are up, price cut percentage grows. It was very, very bad in 2022. Price cut percentage being that low is very unhealthy. Just to give you guys an example, in March of 2022, we only had 240,000 homes available for sale in the entire country. We are a country of 340 million with 162 million people working. That's all we had. I called it the savagely unhealthy housing market, and this inventory growth had to get back to normal. It did. So the future of your business can grow because affordability gets better that way. But the price cut percentage is actually negative year over year. Now, unless you have this data, It's going to take 3 to 4 months for this to catch up with the NAR report or the Case-Shiller index. But because rates are lower, demand picked up, that supply and demand equilibrium has now, for the first time in years, price cut percentage is a little bit lower. Pricing just firmed up a little bit. We still have a healthy housing market. It's nothing like we had during COVID, but the pricing market's already changed, and our data is months ahead of everyone else's. This is why we knew in June and July that the housing market was shifting. A lot of people thought home prices were crashing in the second half. They saw the Redfin. How many people have seen that Redfin chart where it goes, it's the greatest seller buyer inventory market in history? Yeah, okay, so 2007 says, hold my beer, because that was 4 million here. This is 1.22. They say their chart and their life started at 2013. But now, again, all of you have this data because the best antidote for fear is data. And then once you show it and you can explain it, you basically can show what's going on in the housing market. Now let's look for single-family homes in Utah. Similar to what we are seeing nationally. Inventory is falling, and at this slope of this curve is going to be actually negative versus 2025 data. Very simple. Rates are lower, affordability got better, demand picked up a little bit. The growth rate of inventory last year, which was working with elevated rates, can't support the same kind of inventory growth. And again, we do this for every city, state, zip code. Wall Street comes to us, the Federal Reserve comes to us, the White House shares my articles and talks to me about housing. This is a data line that just says the housing market just got a little bit better and inventory is not escalating out of control, as some people were talking about. Now, when we look at the single-family new listings for Utah, looks very similar to the national market as well. We're getting year-over-year growth. We're going to try to get back to normal out there. Very, very healthy, right? And that's the theme, is that because inventory is up, price growth has slowed down, mortgage spreads are better. You know, it's a much healthier backdrop to do business. When rates go back up and down like crazy, it doesn't do anyone any good. In the last few years, we have rates get down to 6%, and then all of a sudden they shoot up to 7%. It kills the momentum. But now, because of the spreads, people can say, hey, listen, I could list my house. I don't have to worry about rates going up to 7 or 7.5%. I feel good that I could sell my house and buy that other one. So that's how housing economics works. You have a lot of baby boomers and Gen X people that are sitting there, put their house on the market. They need that mortgage buyer to buy that house, and then they come and they sell and they buy another home. So that's how the transaction model comes. So Utah is actually very, very healthy new listings data for the year. And the price cut percentage here, it's actually already lower. You know, so Utah looks a lot like the national housing market. And again, we can break this down for any zip code, any city. That's what a lot of people come to us for. My job is to explain the national economics. But now all of you get to see, we already started the year in a much healthier spot. But because of mortgage spreads, we could actually stay near 6% for a long period of time. Now, a lot of people, I talked to Brittany about this, who say, well, people are waiting to, you know, have mortgage rates go down to 5 or 4 or 6% or something very low. The history of mortgage rates getting below 5.75 with the Federal Reserve talking about neutral policy, it just isn't there. That's why my forecasts pretty much end at 5.75. The Fed has to get dovish, the labor market has to go into recession. If those things happen, then you could get that. But if people are waiting for, oh, the Fed's going to cut rates, we think rates are going to go to 4.5, 5. Not here with history, right? Mortgage spreads could get better. You could get a little bit lower in the 10-year yield. You might be able to get a little bit below 5.75, but that's it. Unless you have a recession, this is kind of the low level of mortgage rates, which can be very operable with the housing market currently.
So they're not getting 3%?
They're not getting 3%. The only way you get 3% mortgage rates is Federal Reserve is at zero interest rate policy, and they stay there for a long time. And that's only happened in the last decade and during COVID. The Fed funds rate at neutral, it's mathematically impossible. It's never occurred in history to get 3% mortgage rates with the Fed policy at neutral. Remember, 65 to 75% of this is Fed policy. Rates look pretty normal right now with that in mind. Foreclosure crisis, we get it every single year. You see these headlines, foreclosure was up 20%, 30%, 40%. I call this my tombstone chart. Sarah Wheeler and myself, we have a top 10 business news podcast, HousingWire Daily, and I always tell Sarah, when I die, you put Chart Daddy on the tombstone, and you put this chart here. If you run into clients who are worried about foreclosures, that's the #1 click thing on YouTube, foreclosure crisis. It scares people into thinking about buying. The housing market back then was breaking in 2005, 6, 7, and 8. This is their foreclosure crisis that they're scaring your clients. This chart right here has changed so many people's views on the housing market that it's become my tombstone chart, because back then, I mean, think about how many economic cycles we've had post-World War II. We've only had one foreclosure crisis, and that was it. Massive credit boom, massive credit boom. Look at the bankruptcies in the early part of the century. So why did everything change? Two laws. 2005 bankruptcy reform law, which means you cannot just pile up credit card debt and file for bankruptcy so easily anymore. Then the 2010 qualified mortgage law. Those two things secured the best middle class and the wealthiest middle class in the history of America. So even with home sales crashing, this is all you have. So you run into clients, now you have the data. You tell them, homies, it was going crazy back then. This is not it. We're not even back to pre-COVID levels yet. There'll be a job loss recession at some point. Delinquencies will rise. But we've had many recessions post-World War II. We've only had one foreclosure crisis. And one of the reasons why is all of you put your homeowners in a great financial spot. This is the FICO scores of America. Right now, the 740, 720 and above are rising because we're originating more loans. These are purchases and refinances. The best middle-class FICO scores in the history of the world right here. A lot of people think, well, there's FICO score inflation during COVID. No, we were just doing a lot more loans. Again, qualified mortgage, 2010 changed the entire landscape. Not only for the housing market, but for the US economy. If it wasn't for COVID, we'd still be in the longest economic and job expansion in history. You're gonna hear people that say, credit card debt, 1.25 trillion. Credit card debt rises with every single expansion. I'll take your 1.25 trillion credit card debt and I'll put it against my $200 trillion of financial assets in the United States of America. We win always. We are the wealthiest, most powerful economy in the history of the world, and homeowners on paper have never looked better. Are there stress in FHA? Yes, there's always stress in FHA loans. Is it gonna happen in the South? Yes. But in general terms, there's a reason why this is down here. And remember, that was happening before the job loss recession. That's the trick. That was an anomaly period. For 100 years of data, foreclosures were rising before the recession happened. Now, 2026, not much going on. So where do we see stress in the credit data? Low-income housing, low-income renters, single households. Student loan stress is back in talk again, but here's one thing about student loan debt that not a lot of people know of. The majority of delinquencies in student loan debt, guess where it comes from? Anybody want to guess? College dropouts. And guess what the average balance of that is? Less than 10,000. So we had the longest economic and job expansion in history with a student loan debt crisis that millennials weren't going to buy homes. Millennials were the biggest home buyers in America back then. So when you run into people that say, oh my God, credit card debt, auto loan debt, everything, renter financial profiles, not homeowners. There's a reason why they created that $10,000 relief fund for student loan debt. You do that, that's majority of student loan debt in this country is gone. Because majority of the student loan debt is actually $14,000 and under. So we do see stress, we do see it in the lower income side, but we don't see it in homeowners. There are some FHA lending loans, especially in the South, that's picking up, but that actually is not even back to the normal levels in the early part of the century. So when something crazy or bad happens, the reason people come to us is that we have the new listings data. And this was running at 250 to 400,000 per week for years. Why? Those weren't sellers that were going to be buyers. Foreclosures, short sales, bankruptcies, everything. So the housing market is pretty normal this year, and people want to make it a little bit more than that. So another beautiful thing that we have in America, I know a lot of people believe in the theory of a mortgage rate lockdown, that nobody in America will sell their 3% mortgages to buy another house. That is a very doomsday theory. Because if that was the case, Gen X, baby boomers, none of these people would sell their homes to buy, but you can now. So the kicker is, if I took all the homes in America, put them together, with mortgages, without mortgage, the loan to value is 44.3%. This was 85 in 2008. You have 40% of homes that don't have a mortgage. You have the lowest LTVs in the history of Earth, right? You have FICO scores that are the highest quality homeowners in history. We're good. When affordability improves, demand will pick up, and that looks very normal to every cycle. But the big fear things, you could have taken this away 10 years ago with proper data. But now all of you, once you get this data, you can show clients this. And my job is to always talk about this every weekend to keep people updated. Now, two more data lines. Number one, homeowner vacancy rates. You guys have a product that people need every single year. You don't really have to market housing too much because home sellers don't sell their homes to be homeless. And here we are with the biggest crash in home sales over 3 years of the lowest home sales when you adjust it to the workforce, and the home ownership vacancy rate is 1.1. Because people live in their homes and they don't sell to be homeless. Even in 2008, the worst crisis ever in housing, never got to 3%. Another data line you could show your clients to say, hey, this is not that marketplace. Now, what has risen, which is positive for everyone in this room, is rental vacancies have risen. Why is that important? Because 40% of inflation in the CPI report is shelter. So more inventory, less inflation, Fed could get a little bit more dovish, positive. So this is actually a very positive home buying and home selling chart that this has gone up because it's really hard for inflation to break away without rents breaking away. It's really hard for rents to break away when wage growth is cooling down. So all these backdrops, everything that I've talked about today is positive where I couldn't talk about any of this in scale terms the last 3 years. So the setup is finally there. A lot of people talk about, well, Wall Street's buying all these homes, they're gonna stop that. Wall Street, less than 1% of all the homes out there. It's not that big of a story. A lot of people say, well, mom and pop investors, why don't they just give them tax breaks, have them sell all their homes? Millions of homes will come onto the market and affordability will improve because prices will crash. The only problem with that is, who lives in those homes? People. So when they say they're going to kick off all these people, you're going to have millions of families displaced in a lower supply market. What does that do? Inflation picks up. That's why that doesn't happen. So this is a positive, and this is a positive, right? So now you understand how the housing ecosystem works. But this way you have live, fresh, weekly data, and we try to explain this. So if you want access to this presentation, all the charts here, you can get it. But if you want to know what's going on, you can go to the HousingWire website. You could do it. We have availability to do zip code data, state data, city data, anything you want. You can get the data lines that the people come to us. Like the Fed comes to us. I joked because I always bash the Federal Reserve in our podcast. Well, then I laughed because I saw Federal Reserve emails. 100 of them bought our subscription. My job is to keep everyone ahead of the game because all this data that we have is fresh and live and weekly. But now, if you take all of this to your clients, to your coworkers, you can explain it better. And what I see is the housing market got a little bit better, right? It isn't going to be a booming V-shaped recovery, but rates are lower, spreads are better, inventory is up, price growth is cooling down, housing affordability gets better on its own, but with lower rates, the buyer pool gets better. Once the holidays and snow is gone from the data, we can grow sales, but not only just for this year, but for years to come. Because the marketplace that created the savagely unhealthy housing market during COVID is gone now. And this is the best backdrop for anybody. Does anybody have any questions on anything I just talked about?
Yeah, so you talked about early payoffs. Bill Ackman recently tweeted out that there's like this possibility of maybe getting rid of some of those prepayment penalties, or at least letting a homeowner like opt in or opt out, and that if they opted in for 6 months to a year for a prepayment penalty, that would drive rates quite lower, like almost 0.75%. I'm just wondering if you could either.
I 100% disagree with Bill Ackman, which is actually very common. Mortgage spreads are already back to normal. So what Bill Ackman is talking about, that if you let people opt in an election year, prepayment penalties, boy, the consumer hates that, right? Because there's such a bad vibe with prepayment penalties. I actually wrote about, getting prepayment penalties back for a year or two in the last decade to maybe help with volatilities of the spreads. That hasn't gone anywhere because it doesn't pull well. If you tell an American you're going to have to pay a prepayment if something happens and you want to sell or refinance or anything like that, there's just not a lot of history to get rates lower than kind of what they are right now. So it was an interesting concept, but it's also very difficult to achieve. We've thrown out, how many things have we thrown out? We had a 50-year mortgage, okay, a portable mortgage, a assumable mortgage, banning Wall Street. They're throwing everything out there. Why? It's midterms, right? And one of the things, people want to sell and buy and move homes. I don't think that's going to have legs because spreads just don't get too much better than where they are right now.
You talked about the labor. How much of the government jobs that aren't in those reports factor in?
You mean the government workers? Yeah, I mean, government workers are a small sliver of the total workforce. So even though they have been fired off starting in October, their severance pay went out. So they're already all into the data line pool. But when you have 162 million people working, and this is a good thing, very, very nerdy stat, 1.5 to 2 million people lose their jobs each month.
How many?
1.5 to 2 million. Every month, that's the norm. We are slightly still below that. And that's why jobless claims haven't risen. So even with the government workers, the labor pool is not breaking. History says when the economy goes into a recession, economic growth slows, investment slows, industrial production slows. None of those things are here. When it breaks, jobless claims tend to rise up higher. So even with all the government workers, it's still too small of the marketplace to really move the general
Were they
data.
padding the numbers with government jobs?
Yeah, well, they were in severance. They weren't technically considered unemployed, but that's already all into the system right now. So they're already baked into the cake. Once their severance is done, the unemployment rate is adjusting to what it is. Now, this gets impacted because the labor force growth is less. If there's more people looking for work, then the unemployment rate can rise. Kind of like what we saw in January 2022 to 2024. The unemployment rate was rising even though we were creating jobs, because the labor force growth was bigger. Now the labor force growth is smaller, so it's kept the unemployment rate lower than what it really is. But the labor data is not breaking to get rates to that next level lower and for the Fed to change their mind. They need to see jobless claims start to perk up for that.
Do you think the gig economy is impacting jobless claims not increasing as much as?
To a small degree, but generally jobless claims have never broken while the economy is growing 2, 3, 4%. Industrial production is rising, retail sales are rising. Usually all those things move together at once. And then the unemployment rate rises because jobless claims are rising. So people are finding work. We also have to remember, we are an older country now. I always say no country has a Dorian Gray labor market. The baby boomers are retiring, and then they're going to pass off. So the millennials and the Gen Zs that are coming here, they're just replacing them as they retire. We actually have more Gen Z workers than baby boomers now. Gen Z is over 17 million, the baby boomers are under 17 million, the millennials are over 50. So it's hard to have high unemployment rates when you're an older country. Japan is a great example. 40% of Japan's population will be dead by the end of the century. They sell more adult diapers than baby diapers there. But their unemployment rates are really low because they don't have enough people. And for the first time, Japan is begging people to come to their country, which they've never done before in thousands of years, because simply when your population growth is dying off like that, you don't have enough workers. That's part of this story here. But the gig economy helps people, but in terms of somebody losing $70,000, $80,000 in salary, going into doing Uber or stuff like that, that's just a short-term fix out there. So it doesn't move the needle as much as people think.
You mentioned a lot of evidence of stabilized rates, but what do you expect out of the chancellor with that chair?
This is an interesting question because Kevin Warsh, I hated his nomination so much that I had a hashtag anybody but Warsh, nobody but Warsh. Kevin Warsh, in real terms, would be the worst Fed chairman for the housing market, but I always go, Kevin Warsh 2.0 is going to do Trump's bidding. And how I explain it is very simple. Trump's family and Warsh's family have been friends for decades because Warsh's wife is the granddaughter of Estee Lauder. Grandpa was a friend of Trump in the White House, so he trusts Kevin Warsh. Does that change my mortgage rate view? No, because a Federal Reserve chairman is one vote, and they've got 12 people out there voting. So he's going to be much more dovish than Powell. He's going to talk about needing lower rates. All that is positive going out in the future, but does it move the needle? If they had more dovish people as governors, it would. But the problem with Kevin Warsh is that he made fun of the Federal Reserve for 10 years, and the people in the Federal Reserve hate him. And now he's their boss. So you can imagine there's going to be some contention there. But because he's going to do Trump's bidding, he's going to be he's going to be better for the housing market. When Trump leaves, if there's a Democrat president, that's going to be a whole different story. But for now, it's still a net positive, but I just don't see other governors going in with more rate cuts than what the market is pricing in until the labor market breaks. But still a positive from Powell's talking points in the past. Anybody else?
So how many rate cuts do you actually see happening in 2026?
So neutral policy is almost really priced in. We have 2 to 3 more rate cuts, and that's where everyone's converging their Fed funds rate is. Because of that, we're almost pricing in neutral policy already. Anything below 2 to 3 more rate cuts really needs the labor market to get worse. I'll give you a good example. Stephen Myron, who was the trade guy, who's now a Fed governor, which is funny to me still, he even started reducing his rate cuts this morning. He had 1.5% rate cuts, now it's down to 1. 1 basically gets you to where all the Fed governors can maybe get to, maybe not at the end of this year, but mostly at the end of this year and next year. So more rate cuts will come, but to me, all this really, the labor market was the biggest driver of rates, more than the Fed, because if the labor market didn't get weaker, the Fed's policy required higher rates. But we're looking at 2 to 3 on average, maybe 1% more rate cuts in the system, which means ARM loans get better. This is the first time that a lot of borrowers right now are getting sub 6% ARM loans. We don't usually see ARM loans grow when rates start to fall down, but 0.7% could be the watermark. If the 10-year yield goes down and the labor market gets weaker or the Fed gets dovish, there's your avenue for sub 5.5% rates. Yeah, that's the way you get there mathematically with how rates have worked for over 100 years now.
Yesterday's podcast talked a lot about new construction and why do you think that won't fill the gap on inventory because of that?
Yeah, very simple. The builders, I would say, are not the march of dimes. They're here to make money. The history of the home builders is that, here's a good question for everybody. How many homes do you think there are available for sale for the builders right now? Like, as of this moment, how many homes have they finished and completed for anybody to buy? 120,000. That's it.
Nationwide?
Nationwide. 120,000. If you go back 7 decades, when the builders get to 120,000, they pull back. Why? Because what do they want? if they build more houses without the demand kicking there, what's going to happen? They're going to have to do more price cuts. They're going to have to do more pay. So I always say, they're not the march of dimes. They're here to make money. So whenever we get to 120,000, housing construction slows down. What's happened? Housing constructions have been in a recession for 3 years now. So it makes sense to me. Rates go up, new home sales don't get much traction, but their units of sale, even though it's 120,000, is a lot for them. Because why? There's 147 million housing units out there in America. Like 2 weeks of our new listings data, just 2 weeks, overrides all the homes completed for sale for the builders for 6 decades, right? So don't look for the builders to put their heads down and start building. Majority of all inventory comes from the existing home sales market because the stock of housing is much more. So this is a really good example to talk about this. When we look at this, we had 2 to 2.5 million active inventory, right? That was norm. But those pesky millennials kept on buying the homes and not giving you one, so we got down here. So we work ourselves back, but don't look for the builders to be the savior ever out there, and there's a reason for that. And they're just behaving like they have for 6 decades.
So is there, I mean, I don't know, I hate to suggest how do we make that happen? Is there a policy? Is there what? How do we get money?
So there's 2 ways. In June of 2021, I wrote an article saying when rates go up, construction is going to stop. If the government basically tells the builders, build these homes, we'll buy them for you. Don't worry about it. We'll take all the responsibility. That changes the 6-decade economic cycle of the home builders. Will the government do that? Not really, probably. So it's very hard to get the builders to change, because if you start price cutting, then you have to start firing people, and then you have to do less productions. They're managing a system where they buy land and they look at their forward data, and by the time they build a house, it's 12 months. Who knows where the rates will be? It's a very difficult industry to time. Right now, they're very defensive because they're worried that if they keep on building or adding more permits, inventory will go up. You see that in Florida. The South had 60% of all the production of new homes, and now that's the area where they're making the least amount of money, and in some cases not making money at all. So the builders are acting very according, like every good business or woman does. They're managing their supply because they sell homes as a commodity, where the existing home sales market that all of you work in, seller versus buyer marketplace, completely different. So this has been my premise for 2 decades, and we're sitting here with housing starts not going anywhere, permits not going anywhere, when everybody was told that they were going to build a lot of homes. All we have today is 120,000 units.
Are there any rate charts that show if the rate has like a discount point or an origination fee, or is it all just kind of like a general average?
It's all a general average. Now the builders have to legally show that they're paying down rates. So when they offer 4.75 to 5.75, you see it in their income statement. They use their profits to buy down rates. Now, home sellers can do this, but home sellers are like, no, I want to make the most amount of money as I can, because they sell a house and they got to buy another one, where the builders don't. So the new home sales market is very small compared to the existing home sales market. So the market rate is just the general market rate without any points or originations or anything like that. But people that buy homes, especially from the builders, they get a discount. That doesn't really flow in the general data out there. HousingWire has a part of our mortgage rate system. We have a lock rate data line, and it shows what people lock the rates for. It doesn't really deviate too much from the general rate, just because the existing home sales market is the bigger marketplace. So it roughly is the same. It just lags maybe 2 to 3 weeks.
So the rate on that rate sheet is showing at par typically?
Yes, that's just basically the normal rate. And we always like to show the poly lock rates so people can get an idea. And then you could match that with Mortgage Daily. Usually Mortgage Daily is a little bit ahead, and then the rate locks kind of come after it. They trend together for a very long time. But the builders are the ones that are just using their profit margins to pay down rates as much as they can so they can move product. Anyone else?
So you said we're almost to a normal year. What would get us a normal? What would you call
This year, inventory growth is almost back to normal. We're going to get that this year. The price cut percentage looks to in a normal rate. The new listings data looks like it's going to be a normal rate. Home sales should pick up 237,000 this year compared to last year, and mortgage spreads are almost back to normal. All those things were never in place after 2022, but they are now. So this is why I say it's a normal year, because if I take it started as a normal year, it's going to end as a normal year, and this means for the next few years it could be back to normal. As long as inventory is up, price growth cools down, spreads are normal. All these things were not here the last 3 years. They're finally here. This is going to be the first calendar year that everyone gets to deal with what a normal housing market looks like with different variables.
Does a recession change that?
A recession means basically rates go lower and housing demand picks up. So oddly enough, a recession, all of you do more business, because what happens is mortgage rates go down another leg lower. That has nothing to do with the rate cycle that we've had in the last few years. That means rates between 6 to 8%. Recession might get you 4.5 to 5.5%. And this is why home sales always start to perk up after the recession happens, because rates stay another leg lower for longer. And that looks like every housing cycle we've had since 1968. Anything else?
Okay, one more. So you were saying like the home price cut is at 32% right now?
Yes. No.
And that's a good year, or that's average? Because I have so many clients who are always like, home prices are dropping like crazy. I'm just gonna wait until they keep dropping. So when is that, I guess?
So here's the thing. Normal is 33%. But national prices falling is just very rare. It just does not happen. And again, if you take 2007 and 11 out of the equation, so what I try to teach people to show is, when's the one time that home prices actually fell? Inventory is 4 million, 1.22. Monthly supply was over 6 months, monthly supply is under 4 months. So supply and distressed sellers have been the #1 reason for home prices to fall noticeably nationally. Of course, Florida market is different, Texas market, Colorado's, but on a national basis, that's the only period in 100 years that it's happened. So supply and distressed supply were the only big drivers. The 1970s was a great example. Mortgage rates went from 6% to 18%. Home prices didn't fall 1 year during that, even when home sales started to crash and rates go lower. So we can do this for every single zip code. That's where people come for us for our work. We can show realtors and loan officers what's happening in their own marketplaces. But we've had price cut percentages go up to 40% last year. And what occurred was home prices growth started to firm up. Let me get that chart. So the price cut percentage got up to over 40%. Home price growth was coming almost down to flat, and then rates went lower, and now the price cut data has firmed up. So the last existing home sales report, when sales crashed because of the holidays, home prices actually grew more month to month. So when this data line starts to break under year over year, pricing firms up, doesn't explode. Now, what do we see in 2022? Vertical. That was a very big slope of the curve. 2022, home sales had the biggest crash ever. Home price cuts went from 15% all the way up to over 40%. Home prices didn't fall in 2022, but they did fall in the second half. You know, that was a very crazy year. When I think about over the last 100 years, 2022 was the craziest housing year ever. But when pricing gets really weaker, our slope of the curve gets very weaker. Now it's actually positive year over year. Again, this is like 3 months ahead of the NAR, and this is like 3 to 6 months ahead of the Case-Shiller Index. We use this as our forward guidance on what pricing is doing nationally, but you can break this for every single city, state, zip code you want in America. Anyone else? Going once? Going twice? Thank you all for having me. Oh,
One more, I was
okay.
Okay, I'll just ask all the questions. So the administration's come out with 50-year mortgage, they've come out with portable mortgage, they're talking. Obviously, those have kind of pittered out. Do you think there's anything that they could or should do that would help, or do you think it's just like letting this all?
I went on national TV as soon as that came out and I go, hell no. on the 50-year mortgage, no. Portable mortgage sounds good. They don't work because you can't rewrite the contracts. So those are, the Trump White House does test balloons out there, and 50-year mortgage had the most negative, it pulled so bad that they had to take it off as soon as they talk about it because it was just a 73% negative rate. We just let the marketplace kind of endure itself, and then it takes care of itself, because what happens is you need inventory to rise and you need price growth to cool down. If you do anything to stimulate demand, it just prolongs, the housing recovery, or it doesn't let the housing recovery take its natural course. This is why I'm like, I wouldn't do anything, right? I would just let it take its course. I have no problem with the mortgage-backed security purchases because it's not that big of a deal. It's already gotten better, but markets run its course, and what we've seen is if you let the market do its thing, housing tends to take care of itself. And this is 3 episodes of home sales crashing, but we're not going any lower right now. Affordability gets better, rates rise, and mortgage rates go lower. Demand starts to pick up like it did in the early 1980s when affordability was worse.
So leave the government out of it.
Let the marketplace handle itself. Yeah. Oh, one last one.
So tell us what you say about the silver tsunami.
Yes, the silver tsunami is my favorite subject for 20 years. In 2008, the first baby boomer hit 62. And from 2015 to 2025, all the baby boomers were going to downsize, sell all their homes to millennials who couldn't buy avocado toast, which means they can't buy their homes, and inventory would get to 26 to 32 million. People have used this same grift for 20 years. It's amazing, even some people on TV recently. And the years where the silver tsunami was supposed to happen, inventory fell. The years where we had more baby boomers die than any other time in recent history, inventory fell. So it is an awesome grift. It's worked for 20 years. It's still doing. Now, 10 to 15 years from now, the baby boomers will die. And when they die, they will leave their homes to their children. And what their children do with the house changes the inventory. But the silver tsunami was starting in 2008. And 2015 to 2025 was supposed to be the great downsizing, and I call it tombstone economics. They love their homes. They're going to live in their homes until they die. So in death, that'll be something else, but it was such a great thing to talk about for 20 years, and we're sitting here 1 year after the last year of the silver tsunami with 1.22 million active inventory. It was supposed to be 26 to 32 million by now. So very, very close. All right, thank you so much. It was a lot of fun.
Real quick, by show of hands, how many of you are going to look for the Levi commercial on YouTube?
You can't find it.